Welcome to the latest Motley Fool Scoreboard. I'm on in Chockaballoo. We've got longtime fools, Tyler Crowe and Jason Hall, giving a 1 to 10 rating to a REIT that used to sound exactly like the name it sounds like. Did I say that right? Who knows? Mid-America Apartment Communities, but now it's just MAA, like the REIT version of KFC, and its ticker symbol is MAA. We'll talk about the business, things like factors like industry and competition. A 10 is invincible, a 1 is hopeless. Jason's at an 8. Tyler, you're at a 9.
Yeah, I mean, providing housing seems like one of those businesses that could be, around for the rest of human existence. I don't know, until we all go up into the cloud. So I think there's a little concern of lack of demand, I guess you will. MAA's focus on the Sunbelt region of the United States certainly gives it a slightly higher growth profile than other residential REITs in other places across the U.S. So nice little kind of boost to growth there. I wouldn't call it workforce housing that they do, but its tenants are mostly young and single. And, you could point that as a positive, workforce housing-esque, always young, single people moving to places that are new for work. Or you could view that as a negative, meaning that they have higher turnover of their apartments than like couples and families that tend to, reside in the same place longer. So overall, pretty good.
Yeah, Tyler, directionally, I think you and I are relatively aligned here, but my score is a little bit lower. The reason I rated an 8 is that, again, the trends are very favorable for multifamily housing. And MAA's management was very smart to point the company at the Sunbelt early in the trend of that relocation of a lot of the population moving to that area, creating that misnomer. It's a very well-capitalized business. Management has been really smart about how they use debt and equity capital to fund expansion. They've also been pretty good sellers as they've transitioned geographically to selling off non-core properties. I just can't go as high as Tyler because it's still a cyclical business. Talked about the younger demo of its core tenant, and that means higher customer acquisition costs. And it's still very subject to external financing costs because it's a REIT and REITs use a lot of debt.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Both of you are still high here. Tyler, you're both at 8.
Yep. Long tenured leadership here at MAA. Eric Bolton has been the CEO since 2001. He's been the chairman of the board since 2002. The company has a great track record under his leadership. I mean, it's one of the few REITs out there that has significantly beat the market over his time as leadership. And I really appreciate that management's compensation is tied to growing funds from operations per share versus just growing a pot of money regardless of the per share value. So the alignment of metrics that drive value for shareholders, I think, is important.
Yeah, we don't always see that when we have the joint CEO who's also the chairperson of the board, and a lot of times the management, the compensation committee then rewards that person for doing all of these jobs and for a long tenure versus incentives designed to challenge them to create value for shareholders. So I think with this kind of business is where you require external capital to grow, having a tenured, competent CEO and board that's tied those incentives to do the right things is worthy of a really high score.
Financials, a 10 is a fortress, a 1 is yikes. Once again, Jason, both of you are an 8.
Yeah, I wanted to go higher. The vibes feel like they should be higher. But the reality is that we've seen some deterioration over the past few years in some of those leverage ratios. And there's two things that are affecting that. Interest rates have moved up, and that's just not cost of new capital. REITs roll their debt over. They don't pay it off. So it's going to affect existing debt as they refinance it. They've also added a lot of debt because of a lot of the growth into the Sun Belt. Of course, that growth is coming along with more cash flow and FFO per share that it's driving. But we've also gone through a period of higher competition. A lot more inventory has come online in some of its best markets. So all of those things together, the books are not as strong as they were, say, 5 years ago. So I think investors should just really keep an eye on that.
Yeah. 8 as well. You have to grade on a curve when you're talking about real estate when it comes to balance sheets relative to other industries, because real estate just uses a lot more leverage than almost anybody else. But despite higher leverage compared to, tech companies, it still has an A- credit rating from the rating agencies and a net debt to EBITDA ratio of 4, which again, by real estate investment trust standards, is pretty conservative. I'm also kind of impressed with its balance sheet when you consider that it does a lot of ground up construction. So, a lot of additional capital that kind of takes a little bit more time to play out, but it hasn't issued a lot of stock to meet those funds whilst keeping conservative debt leverage. Those are pretty encouraging signs.
Tyler, let's move on to valuation. How well will MAA stock do over the next 5 years? And how safe is it? A 10 is a sure thing, a 1 is a lottery ticket.
So I gave 5 to 10% returns with a safety score of 8. I think MAA could suffer from the law of large numbers here, where it's going to be harder to grow at the same rate that it has. I mean, it's an $18.7 billion market cap company now. You just can't move the needle with a couple properties like you used to when, I don't know, it was a couple $1 billion. Also, the dividend growth has slowed down a little bit. So with a current yield of like 3.8% and dividend growth of 5%, it would take significant valuation expansion to get more than 10% annualized returns, in my opinion, which I don't know if is in the works. So, 10% sounds pretty accurate to me.
Yeah, Tyler and I, we came down on the exact same scores for a lot of the same reasons. I want to add the cost of capital back in there too. So it's not only do you have to either buy more or build more to get those rates of growth that we've seen in the past, you have to make the deals work even better in a higher cost of capital environment and the fact that everything else costs more too, whether it's land, labor, or lumber. And that's just headwinds to making the business bigger, generating more cash flow, and also growing the dividend at a faster rate. So, but I do think as long as management continues to prioritize strength over empire building, it's a great foundational high floor stock. But if we see a continued protracted bull run for the market, it's probably not going to beat the market, but it still could serve a place in investors' portfolios.
Land, labor, or lumber. You need to trademark that, Jason. I like it.
Oh, I'm borrowing that one. Somebody else already came up with it.
I was worried that was the case, but trademark it before they do. Let's move on to top it. Tyler, is there a company in MAA space you like better?
Not necessarily in residential. Real estate investment trusts, residential are kind of divided into two camps. You have quality companies with modest growth, low leverage, low yields like MAA, or you go with the higher debt, higher growth, higher yield options that look riskier, especially at a time of higher interest rates and, like Jason was saying, higher cost of capital.
Yeah, I come down along the same lines, but I do want to just put a business out there for investors that might be looking for more risk reward. Invitation Homes is interesting. It's a REIT. It's still rental, but it's single family housing, and it's a much smaller business. But all of those cost of capital pressures are still there. It has a more leveraged balance sheet. So again, more risk there. But I think we're going to see more and more renters that are going to look for single family homes because housing prices are so expensive. And that could be a positive for Invitation Homes.
Thank you to both Jason and to Tyler. They've given MAA a good overall score of 7.5 out of 10. It missed the magic 8.0 only due to mediocre return expectations. You know what that means? This one gets really interesting on a dip.
Yep.
Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Next Era Energy. Till then, Fool on.